You're listening to Burn Rate and Bullshit.
The show where founders, suits, and corporate clowns all get called the fuck out.
We're Josh Robinson and Mike Nathan, entrepreneurs turned VCs.
With zero filters, strong opinions, and a bullshit detector set to high.
Welcome to the only business podcast that actually tells it like it is.
I'm a desperate man. Send lawyers, guns, and money. This shit has hit the fan.
Every pitch deck has that cute little slide with potential acquirer logos slapped all over it. Apple, Google, some random private equity firm your banker told you had to add. 90% of the time, it's pure fantasy. Real exits aren't about vibes, they're about fit, timing, and whether your numbers and a narrative actually solve a problem for the buyer. Your end game is just IPO someday. You might as well write, please God, bail me out, and call it a strategy.
Founders talk about exits like they're all the same. Money hits the bank account, champagne pops, roll the credits. What they don't tell you is the version where the strategic buyer buries your product, PE loads you with so much debt and keeps you grinding away for another 5 years. Or the IPO that turns into a public market hostage situation. There's more than one way to cash out and plenty of ways to sell your company and have it still feel like a loss.
Let's start with what are the exit paths that are possible, just at a high level. So the one most people think of, because it's probably the biggest and the sexiest opportunity, is IPO. You can go public.
Sure can.
You can be acquired, which is the usual. That's probably 9 times out of 10.
Another company or entity just buys you.
Yeah. Strategic, so someone in your space or private equity buys you. You can do a secondary sale, which is becoming more and more popular, where you don't fully exit, but you as a founder, your employees that have shares are able to sell to other private shareholders in a private market placement. One that you don't usually talk about because you think of exit as this big liquidity event, but shutting it down. That's one way to do it. And that's not to mean that you failed. It just means, hey, the business ran its course. You could be doing it now for 10, 20 years.
Made $3 million the last 10 years.
Whatever,
Banked
right?
30,
You shut it down. So those are, and there's a dozen iterations or variations of each of those. But those are probably the biggest, broadest stroke. Are we missing any?
No, I think you covered it. And you're right. I do think a lot of people, or again, it depends on the size of the kettle of fish in which you swim. Is that a thing? Kettle of fish, swim in a big pond.
I don't know. I haven't heard that one before.
I'm the analogy guy.
Yeah. Yeah. Not always good analogy guy, but you're an analogy guy.
Yeah. So what I'm meaning to say is the larger the company, IPO seems like a more feasible opportunity.
Sure.
New startup guy, gal starts off with, Jimmy's lawn mowing service. That's not how you're exiting. I do think there is a wild misunderstanding around IPOs that is the likely path, when in fact, you and I both know, and our audience will know, that is less than 10%, 10% of the time, way less than 10%.
Single digits.
Yeah.
It's
It doesn't happen often. The most common one is a strategic acquisition. The most common. It's probably, if I were to guess, I don't have data on this, but it's probably 80% of the deals that get done are strategic. It's your larger or maybe smaller. It's a competitor of yours.
Mm-hmm.
Or someone who's adjacent to your space.
Yep.
Either maybe if I own a nursing home, I might buy an oxygen company because I use a lot of it.
Or an ambulance company.
Or an ambulance company, run on through it. Or, I make sheets or I sell beds. I'm gonna need all that. That's almost always who buys you. And then there's sort of like a moneyed interest where we talk about PE or sort of like a recapitalization of the company where someone comes in, they're not an industry strategic. They're not going to take you IPO, but they're smart, moneyed folks who like, hey, I like this space. I like your company. I'll give you half, maybe more than half, maybe slightly less than half. And you get to take a lot of those half of your chips off the table. Mm-hmm. And now you run it for us and we're going to sell it later. The PE guys and gals, they're going to sell it.
And you get to go along on that ride.
And you get to write up. Or you get to grind along for the next 5 years where they load it down with debt and you get proper fucked and can't get out of it either. There's that.
Yeah. That can happen.
That's likely the case. Because PE's going to get they're going to get paid.
Yeah.
So those are some of the big, and you talked about other exits that are, maybe non-liquidity events. Like you could go just close the business down. You've harvested enough cash out of it. Don't want to sell it down. You know, Y2K, you know, it's something that was a one-time event. You know, we had a business that ends once 2000, which is a complete hoax. We now know. And the other one we don't talk about, but it could be legacy too, right? You could pass down
That's a great point.
You could pass that down to your kids. You know, that one nephew you like that paid attention to you, laughed at all your jokes. Junior there will love this company. And that can be bought out. And the other, you know, in that same vein, it could be, you know, employee stock. You can start an employee-owned company and they can
Sell
buy
to the
it back.
employees. Yeah.
I mean, so there's a couple of those are legacy is probably more common, but being employee-owned, not as, you know, that's like IPOing. That's pretty rare. You need to have a really, really healthy company.
Yeah.
And a really cool founder, ownership team that's like, yeah, let's reward all of our hardworking employees. Said most no one ever. I mean, there's very few employee-owned companies for that reason. People used to be cooler back then. They'd be like, yeah, let's sell this. Let's give a great deal to all of our employees.
Well, and have gone on the record of saying all employees are dumb and lazy. So
Right.
I think it was fat, dumb, and lazy, but yeah.
So they're not the ideal buyer of my company. But those.
So
are
how do you, as a founder, as a management team, how do you decide? You just take whoever's writing the goddamn check. That's who you take it from. Or?
I think day one. I'll take a hot take. Assume you're not going to pass it down to your kids because there are two different paths. If you're going to have a legacy company, you will approach everything slightly differently. You're building a 100-year-long company, and you're going to do things not completely indifferent, but different than you.
You bring a different lens to almost every
different lens.
decision.
Yeah, you'll raise a ton of money on the one that you're going to run up and sell than the one you're going to hang on to. I'm going to grind slow. I got years.
Yeah.
I got years, decades. But on this other path, I think you need to go into it knowing I'm going to sell to a strategic acquisition. That's who's going to buy me. I should make myself look attractive to the rest of the market from day one. As soon as you get out, you're like, hey, if I know I want to sell this company in one big fall swoop, I've got to look attractive. So I would absolutely plan on that. Even if you think you've got the next Facebook and you think you're going to go public, all of the business activities in the first days, the first 2 or 3 years of even going public, everything you would do for a privately held thing versus an IPO, you would likely do almost 90 to 95% of the same things on either path.
Yeah.
It wouldn't change. Later, once you've discovered and you've proven, moreover, that you're way more valuable and there would be an amazing public offering for this, then you would start to do things differently. You would, get your books in order, get your compliance, all your processes and procedures, and a lot of transparency there.
Yeah.
So I think if you're starting a side hustle, you're starting a company, if you're raising, I'll make it up, less than $100 million in your first round, you should be thinking strategic exit. If you're a really huge behemoth, big deal, yeah, it's probably it.
So we've said IPOs are rare, which they are. I also saw a statistic on how long it's taking companies on average to get to an IPO. You want to wage a guess on how old the average IPO is by the time it goes public?
So I'm just going to think through this. I don't know the answer exactly, but I'm thinking no one, unless, again, super mega growth, really well connected, big stuff right out of the gate, likely, but you're talking about the average. Likely you're around for a minimum of 5 to 7 years before you think you've got a credibility where you don't have a strategic and exit.
Yeah.
You've got something you think would be more valuable as an IPO, which it can be if you line it up right. So I'm going to say 10 to 12 years.
Close. 13 and a half is the average age of an IPO this last year. What's interesting about that number, some people may think
long.
It seems long, right?
Yeah.
It seems brutally long. You start a company and you're going to be in it for over a decade before you go public. And on average, and that's an average. So some are far more than that, and some are, of course, much, much less than that. But on average, it's 13 and a half years. That's double what it was 30 years ago. So in like the 80s, 90s, it was a 5 to 7 year window. Just think about Microsoft when it went public in the late 80s. It had a handful of customers. It was doing, a few $1 million in revenue when it went public. You would never.
Is that what it was? I didn't know
it wasn't very big by today's standards. And so you would have to be a really big, mature company now to go public. And that's, I think, what's dragging it out so long is it takes time to get to that type of scale that's now expected by the marketplace.
Well, isn't it also the setting of expectations? Even you might be the new wonderkind, the new hot shot, big deal. But if you haven't done it for a number of years, no one fucking believes you, or
Yeah.
no one believes that it's going to last. So why am I going to go through all this process? And
That's impressive. Is it repeatable? Can you do that for 2 years in a row? Can you do it for 3 years in a row?
can you go through a couple of like up cycles and down cycles?
Exactly
How does that
right.
look? We've got smarter investors too, smarter analysts than we did probably years ago. We've got AI helping us with their stock picks, and they're going to look at historical earnings, trends, etc. But that does blow me away. It's doubled. Do you think that trend continues, or does it end there from an IPO standpoint?
That's a great question. At a certain point, it can't go on infinitely. We can't wait 50 years for a company to go public. So it'll be interesting to see how introduction of AI in new ways here is going to impact that. Could make it longer. Could make it non-existent. Could make it much, much shorter. I guess I don't. Time will tell on that.
Oftentimes, and correct me if I'm wrong on this, because I want to talk through a scenario with that. Why would I want to go IPO versus strategic? Like if I have all the attributes of a strong, healthy, growing, profitable company, or I'm sexy for what another proprietary code or technology or bio breakthrough, I go to IPO because I feel like I can outpace modern valuations in a strategic exit, right? Like there's going to be such a whiz bang, such a wow around what I'm doing. The markets in general will feast over what I've got, right? That's why you do that. So is it?
I think today that's true. You go public because not only are you going to be a player in the market, you are going to be, you believe at least, the market. You are the market, right? And it's so
Market
many.
leader.
Think of like some of the big ones that are on deck for this year. SpaceX. Right? Who do they compete with? And there's a couple out there, right? But like when you think
There's
of
Bezos,
private, right? But when you think of private space exploration, you probably are thinking SpaceX. Like they are the market. They are the market leader. And so many of the IPOs this year, so many of the IPOs over the last couple of years, it's been that. That's the storyline is they are the market. Whereas that wasn't the case 20, 30, 40 years ago. And those companies that are doing really great, have got solid revenue streams, are profitable, have great product, great market positioning. Those are ripe for strategic acquisition. Or, I mean, in some cases, private equity, you want to grab them, throw money in them, grow them, consolidate them with like or similar players, and then go, then pitch it off. But so many of those now are going to strategic.
Well, if you think about, give a, finance bros, we give those guys a hard time, but there's a real effect that sort of those, I'll call them financial institutional buyers and investors, they have a really big effect on this thing we're talking about right now. There is so much at any given time, other than right after Silicon Valley Bank going down, but at most any other given time, there's so much money chasing terrible ideas, terrible companies. And the good ones really get priced really well, and the so-so ones, because those guys have to spend that money. We now are in this really,
and they go into it knowing most of their investments are going to be a wash.
That's right.
Or
So
loss,
they know the math on it. Like, so they won't get too bent out of shape on all of it. I guess where I'm going is, in a good way, we're making IPOs more exotic, if you will, because there's so much money before you get there. I know I can punch out and make everybody millionaires on the cap table, to the investment banker down the street, to the VC or the PE group that wants to take me out. I don't have to do a wish and a prayer and try to go to the public market. Those guys are chasing so much shit. Anybody who's, like you said, I like the way you said that. The market leaders are going public, the shakers, the new makers of markets, they go IPO. Everybody else, they're going to get gobbled up before that. And
that's okay. I mean,
that's just fine.
That's just fine. Yeah.
I mean, I've been through a IPO for a unicorn as an investor. I can tell you how that turned out.
That one's not great.
That one was fucking terrible.
Yeah.
6-figure loss. Multiple 6-figure loss. That was brutal. Started off looking great. We named names.
That's up to you.
Is this where we talk about the other thing? Anyway,
Yeah.
Where was that going with that? Just because you IPO does not mean it's going to be a home run. In fact, it's kind of like throwing dice against the wall in the back alley.
I would say, and I don't have a statistic on this, just anecdotally, think about the last 10 years of IPOs, you can think of just as many colossal years as you can just smashing successes.
Yep. Yeah. So to me,
It's got to be 50-50 or close to.
so to wait, you said 13 years, to wait 13 years to have a shit outcome, why not punch out in half that time for an amazing outcome? Is it because they're greedy?
Maybe.
Pigs get fat, hogs get slaughtered.
I see. That's where that's just kind of
Exit.
how I think about investments. As an investor, if I were to found a company again, I would never go into it thinking that this is an IPO. I would
Same.
always look at it as a
Same.
strategic or financial buyer is going to do this, or we'll recap it. The management will buy it out. I mean, maybe that's another option, that leverage
Yeah,
buyout by the
right.
management team. Like I said, there's 100 different versions of how you go out, but these are the big ones. So, strategic is likely the option if it's going to be where you're headed. How do you think about building the business? What needs to be true for you to have a successful exit vis-a-vis a strategic?
Here's a terrible answer, but it depends. Depends on what you think your strategic buyer is looking for. We know.
I think that is the answer.
Because some strategics will I want a geography. I've got the East Coast and the West Coast, but I got a big fucking gaping hole in the Midwest, in the central part of the country. I need to cover that. So I don't give a shit so much as you've got lots of EBITDA or debt or something like that. They need to cover the middle of the country.
Yep.
So it could be capacity. It could be your tech. It could be your IP.
Could be your people. You could have built a fantastic team that they can't replicate quickly.
Or even just think about, you have access to different channels. Like if I'm trying to get into the VA, I might want to buy a company that's already moving $50 million worth of medical equipment into the VA, as an example.
Yeah.
That would be something you'd buy. Of course, they want you to be profitable, growing, have market penetration, show density.
A lot of that's, though, nice to have in certain deal structures.
It is.
As we're learning in consumer packaged goods, your acquirer doesn't give a shit about your cost structure. They just want to know about your top line.
Yeah.
And they price deals based off of it. I mean, that's what's so weird about CPG is they price deals as a multiple of revenue, not as EBITDA or any other type of metric, because they just absorb your sales and put it into their cost structure. So to your point of it depends, I think that really is the answer. Who do you think is the buyer or the likely buyer? Who are the set of likely buyers? And what's important to that group, and build towards that.
So in the CPG world, and I want to make sure I understand, because I think I know, but I want to hear what you know. They do that because I can take your frozen pizza, your frozen yogurt, whatever the hell it is, and I put it in my factories, and I can make it at a third the cost you're doing,
Correct.
commercially manufacturing someplace else. So when I see that, so you're right. So the same is true in the booze business too, right? I mean, when you see these big Diageo goes and buys up the new hot American whiskey brand, first thing they do is shut that still down because they can make the same fucking thing at their still that's 5 times larger, cost is lower. So then you should know, if that's your strategic, all I give a shit about is top line revenue.
Yep.
To your price, just takes me a while to get there. But to your point, raise your prices. If I get more revenue, or opposite, I lower it so I get volume.
Yeah. Whichever.
Play that game, wherever your brand is positioned. But that is interesting, and some of them are going to want to see growth. So look at like a health plan or healthcare plan or value-based care providers. They need volume. They need tons and tons of volume. My widget, my idea, my plan, my actuary tables are amazing at 3 million people in it. They suck when it's only 250,000.
Yeah.
So as a strategic, you're like, hey, they're going to want bodies. I need to get patient counts, lives, under contract or contributed lives or something like that.
Yeah.
I need to build that. So I think
Which is the equivalent of sales revenue in the healthcare space.
Exactly. So I think what you want to do is know the strategics. What are they doing? What are the trends? And if you're in that business, you should know what's going on with the big boys, right?
Yeah.
What do they buy? I mean, look at what they buy. It's all over. Look at what do they call them? The trade rags, right? Follow what they're writing about, who's buying who, and ask. I mean, how many times have we picked up the phone and talked to our direct competitors? What are you hearing? Who's buying what and why? How much and why? What are they thinking about? I think that's if you're expecting to exit, and when you build that initially, build for strategic. That's part of what your job as a CEO founder is to do is I need to learn and then implement in my company what somebody's going to fucking pay for. Right.
Yep.
And that's,
Yep.
sounds really simple, but so many
as a founder and as a management team, you go through that analysis, you come to the conclusion of, hey, this might be a really attractive opportunity for both a strategic and a financial buyer. How do you decide which one you want to go after?
yes. And
Yeah.
I mean, think about
That would be the smart answer, right? Is both.
Well, what did we just do? We went down, there were financial people
Yep.
and there were strategics. Strategic people won out at the end of the day. It's yes and.
Yeah.
I don't think you need, especially if you're thinking about maybe the biggest check or the best terms, whatever it is, from just that strictly sort of what's the scoreboard say? You want to include everybody and their mother into the process, theoretically. Unless there's some other thing I'm not thinking about that would be.
No, I think the smart answer is if you're attractive to either, approach both then as a part of your process. No, going into it though, as a founder and as a team, what's most important to you? Is it being done? Are you ready to be done? Because if you are, a strategic's more likely going to be the option that takes you out of the equation completely and quickly.
Mm-hmm.
If you're not ready to be done and you want to continue to build this, a financial buyer is probably the better bet for you.
Mm-hmm.
You'll take some of the chips off the table. You'll de-risk the situation for yourself a little bit. You'll put a little money in the bank for yourself, and then you're going to grind it out. Now, you'll likely have you have the potential for a far bigger payout down the road.
That's right. Yes.
And that's the trade-off with a strategic.
The risk continues.
You'll get a lot more money now, but you're foregoing the potential of a lot more money later. So you kind of have to answer, what do you want as well?
And I think you need to understand, just to build on your point, a financial buyer is interested mostly, almost exclusively in what are your financial units?
100%.
What's your percentage of EBITDA added to the percentage of growth, and that better equal what's the rule, 42 or 45 or something like that. Rule of 40.
And can we deliver on our IRR as an investment fund?
That's what they're thinking about. They won't see. So a strategic will like the profitability too, but they'll also give you a value for what they see. Again, it goes back to capacity
Synergy.
contract. Yeah, they're going to put a higher value on you, even if you're a lower EBITDA number than a financial people could give a fuck about your synergy. They don't care about that. Pay me my money. What they want.
Yeah.
So know that going into it. So if you're really, obviously the best spot to be in is be growing a lot and be profitable a lot.
Yeah.
And you'll have lots of options. But if you're not,
That's great insight. Grow and be profitable.
You're not going to find that on
Tell me
ChatGPT.
more.
You're not going to find that on Claude. These are insights. Gemini will have no idea what I'm talking about. These are some good insights.
So, there's a lot of perspective on kind of coming out of COVID era, because there were wild valuations coming out of COVID. Some of them way high, like they paid what for that, and some of them were cratered. Like that is definitely worth more than that. It kind of depends on what business you were in coming out of COVID. And I think there's a lot of sense of, okay, we're still in this kind of nuclear winter around investment. And some of that maybe is true, but 2025, looking back now, I felt it being in that space, looking back on hard data now as it's starting to get published from 2025, it's becoming real. And that is, I think there was a turning point. I think there's been a lot of shift in investment in terms of like private equity and venture capital. And we're starting to see it in the numbers. Venture-backed companies that exited in 2025 was up 150% compared to 2019.
That's a nice.
So it's bouncing back.
Yeah.
Yeah.
That's
So
good.
if you've been in this grind, if you're at year 13 and IPO is not the answer, or if you're at whatever that average age is for your space, it might be the right time. I mean, it seems that the markets are thawing. I mean, so the numbers say that. Do you see it? Do you feel it? Just because you have conversations with people all the time.
Here's what I'd say. It is, everything's up, and we're talking about since COVID. So there's, like you said, a mixed bag of amazing stuff and negative stuff.
Right.
Here's what I'd say. I think people are quicker to do a deal now. I don't
No.
think actual valuations are like what they used to be.
I would agree with that.
And I think, there's a bunch of stuff you can say, you can blame some interest rates on some of it. You can blame like when everybody ran into telemedicine in 2020 and placed huge bets for a long time. And now that all of them are about gone.
Mhm.
Every telehealth platform I know of that was only telehealth, bye. So they took baths on stuff like that. So I think
Are they getting consolidated and rolled into other things,
they're
or are
just
they
going
just they're
away.
done?
I just
okay,
think
they're
away.
going out.
I don't think I know a lot of them. Now there's some that has survived, but barely.
Yeah.
I mean, these are guys that came out at $300 million valuation. They were probably 200 or 150 a year ago. They're probably sub 100 today, even probably doubling their business. Just if you don't like your telehealth provider, just wait 6 months. There'll be a new one. I mean, there's not. There's nothing super powerful that you can deliver. But I would just say this. I think the people with the money have come back down to earth. We felt that there was a esprit de corps of grow for growth's sakes and just go. Just go. Revenue, EBITDA, all that stuff will catch you up later and we're going to stack cash. That ended in Silicon Valley Bank when that went down. When everybody realized, oh yeah, interest rates are going to fuck with the markets and how much we pay for stuff.
Mhm.
It just is. And then we said, okay, don't care about your growth story. Tell me about your profit story. And I think that naturally drives, because it's easier to just grow than to grow and be profitable. A lot of people know how to do the former,
Yeah.
not the latter. So I think, my take on it, deals are happening at a greater pace. And they're getting great value for people that are buying right now, period. And they're buying from people who've been through the dark days. They're happy to be out of it. They're happy to be done. They're happy to have that big check finally land. It was $100 million business 4 years ago, 50 now, maybe some experience with that.
How much are you talking to the cap table throughout all this journey?
Yeah. Well,
Is it part of the
No,
pitch when you're asking for money?
I'll start with the board versus the cap table because everybody's cap table is different, and especially if you've got a very active cap table, they always want to be brought in. I guess you can keep them up to date. Yeah. I think you'll get into a bad spot when you talk to your cap table about exit, because if you say, "Hey, we're thinking about this for exit," guess what they're fucking thinking? And every correspondence, text, email from here to the time you fucking sell is going to be, when are we selling?
Yeah.
How
They're
much we
counting
sell
their
for,
stack.
man?
Where's my money?
What do you think we'll sell for? I don't know, 50 million. And when you come in at 48.5, they're like, well, Mike, walk me through why it's not 50. You mean you guaranteed me 50 million?
Did you not try to get more?
Did you not try to get more for us? Yes. You didn't fight? Yeah, I did. Idiot. So anyway, don't get into that conversation with your cap table.
Okay.
Your board, that's okay, as long as your board's not insane. Your board you all should be thinking about, as board members, senior management, founders, etc. Always be thinking about exit, even when you're years away from it. In fact, when you get to a year out, there should be real actionable plans that you're doing every week, every month.
Right. You got to start getting the data room together.
Yes.
You have to make sure your financials are buttoned down. Depending on what that exit looks like, just process, policy documentation, compliance, all that boring shit, all of a sudden matters a ton.
In diligence.
So don't wait for diligence to start producing that shit. Make sure that's just part of how you operate as you build towards an exit.
I remember when you told me, like, hey, we need to do an audit. I'm like, what the fuck are we going to do an audit? Like, we're not selling for another year and a half. Turns out it was just on time. We just got the report in. Or, ours is slightly different, but right as with somebody, and then they asked for it, half of the diligence.
Have you guys had an audit yet?
Yeah.
Funny you should ask that. Yes, we have.
Just wrapped it up.
Yeah.
And then funny, that diligence list went into half.
Yeah.
Less things to pick at. No way to kind of bark down or poke you down on valuation. So you do need to be moving in advance. So your board should help you with that with experience.
If they're doing the right governance duties.
If they're doing the right governance.
Yeah.
But that's different than your cap table. Your cap table is going to be, angel investor guy and gal that are going to be just grabbing out their wallet. Like, when is it coming? When is it selling?
Mm-hmm.
Why did it sell for so little? Why am I not a billionaire from this investment? I just saw the other company.
Because you gave me $1,000, Grandma. Settle the fuck down. and you thought I was doing something with computers.
I will guarantee you, your smallest investor will,
Your
not might,
biggest-
will be your biggest pain in your ass.
Yep.
It's the rule. The guy who wrote a $10 million check,
Never heard of them.
I mean, all it turns out.
Yeah.
Jimmy, who gave you 10 grand after he hit it big at the casino, he's up your ass every fucking week. Come on. Most expensive 10 grand I've ever taken. Still burns me. That was a decade ago. Still upset about that.
So we've talked about the different exit paths. We've come back to more than once. Strategic is likely the answer.
Yes.
I think from our experience, that would be our preference.
Yep.
If we were exiting,
They
the
find more
company.
value in you too.
And it's a little bit more efficient in finding the value. So what does a good strategic exit look like to Mike Nathan? Real example or
A
just
good
ideal
strategic,
state?
a good strategic is you either complement or completely align with their vision, mission, values, all that stuff, right?
Mm-hmm.
And you can be materially helpful that next or the same fiscal year, either in top line growth, bottom line growth, and most of your people will be retained because, and this is, they don't wave the magic wand, because you've already run a really tight ship, you just add it to them. There might be some people that get lost in that. There's some attrition there, I suppose. But a really good one looks like that.
Yeah.
And the check size is right. The terms are right because they understand. Strategics, we haven't
And
talked
quick,
about
there's
this.
not like a 5-year tail on it.
Yeah. Your strategic likely really understands your business. And they know exactly how to make money, where you've struggled, oh my God, these guys are really good at this. That's what a good strategic looks like. You sincerely, the acquisition of your company makes them better. And thus you'll get maybe more money, better terms, all the things. So I think that to me is what a really good one looks like, where everyone's making money, growing, retained a lot of your people. The check size was big and it was worth it.
Mm-hmm.
Josh, do you have an example of a strategic purchase where they should go lovely, but there's one that you wouldn't go bad? I mean, you've done you've done dozens of the big ones.
There's a headline almost every day where it's a strategic one gone wrong. But people,
Just write it off.
People can read about those from real life experience that I've had. I can't think of a strategic acquisition that was an abject failure, just a horror story. However, I also can't think of one that went completely perfect. And I would say every single strategic deal I have seen or been a part of had some kind of little blip in it.
Some hair on that dog
And
somewhere.
it didn't work out completely the way you expected. Did it still work out largely to the benefit for most stakeholders? Yes. Almost all of them do. I can't say that about financial buyers. I would say financial buyers, private equity deals are much more 50-50 on whether it's going to be a good deal or decent deal for most people. There seems to be more winners and losers in the financial deal side of it.
Yeah.
Which is probably part of the risk reward, right? There's more potential for higher returns.
I think that's definitely true when you're talking like more VC, where they're very early stage. It's been my experience. The PE boys and girls are getting it down cold.
Mm-hmm.
If you don't have 10 years of repeated, consistent profitability, I don't want you.
Mm-hmm.
Not even looking at your.
How'd you get my number?
Yeah, how'd you get my number, peasant? Get away from me. Those guys know how to pick them because they go with, no brainers, no risk. I shouldn't say no risk. The risk comes in what they do after, right?
Mm-hmm.
Leverage the fuck out of it. Let's borrow against all of our profitability and our assets to pay ourselves out first,
Mm-hmm.
and then let's grow the business, maintain the debt. So that's where the risk comes in. But the deal itself, the value, those guys don't miss. They don't miss. Hate that about them, but
Good for them.
send lawyers, guns, and money.
That's it for this round of burn rate and bullshit.
But the only thing we sugarcoat is our coffee.
If you liked what you heard, great. If you didn't, even better. We're not here to make friends.
Hit like and subscribe and share with someone who needs a reality check. Remember, hype dies and execution wins. Stop pitching, start proving.
Next time on Burn Rate and Bullshit, we flip the script. How to actually find deals as an individual investor. No fund, no fancy platform, just you, your network, and your bullshit detector. If you think Twitter threads and syndicate blasts make you an investor, you're not the hunter, you're the liquidity event.
Send lawyers, guns, and money. The shit has hit the fan.